Welcome to Clear Conversations, Entrepreneurial Legacies with your host, John Sleeting, an executive partner for Clearwater Capital Partners. Join John and his guests on this exclusive journey behind the scenes of extraordinary entrepreneurial families. In this series, we will dive deep into the stories of John's guests, who generously unveil the paths they've walked, the challenges they've overcome, and the wisdom they've gained along the way. Throughout these conversations, we explore their achievements beyond mere recognition, disclosing the distinctive perspectives that have shaped their entrepreneurial journeys. We hope you enjoy.
Hello, and welcome to Clear Conversations, the Entrepreneurial Legacies series. Today, I'm delighted to have Tyler Beachler, the Deputy Chief Investment Strategist for Clearwater Capital Partners. Tyler's been with Clearwater Capital for about a dozen years now. He's a Chartered Financial Analyst, or CFA, designation holder. He is one of the most hardworking, intelligent, down-to-earth, humble individuals, and his technical capabilities to solve problems and understand how the world around us is operating and how we turn around and fulfill client strategies is one of the top that I've ever worked with. I'm so appreciative for him as an individual, the character that he brings to our team, and the technical competency that he employs every day, as well as leading our portfolio management team. So it's an absolute delight to have Tyler Beachler here with me today. So let's dig in. Tyler, thank you so much for being with me today in this conversation. We're going to take a little bit of a different tack than we have traditionally. As we've been focused on entrepreneurs and their journey and the legacy that they're creating, we've received a lot of questions regarding how an entrepreneur should think through what investment means very broadly across the life cycle of their time as an entrepreneur and what that means. This is going to be a little bit different in terms of the technical aspect for our listeners and what we're going to be getting into. No better person than you to be joining me in this dialogue regarding how we approach this challenge. I know for our compliance department, we need to put all those caveats on there that I'm sure in writing on the site as well, but nothing that we should be talking through should be construed as advice, legal, tax, financial investment, or anything as advice. Every family, every individual in the family, every entrepreneurial journey is different and really needs to be addressed at that level as an individual. But to go through this construct and this thought process of investing over the entrepreneurial life cycle, how do you even frame that? How do you start that conversation? How do you even think about that challenge?
Well, thanks so much, John, for having me. You've had some amazing guests on, and so to be one of those guests is a huge honor. So thanks for having me. I think when we start thinking about the entrepreneurial life cycle and where to even begin, I mean, there's so many different ways that we could take it. At the highest level, I really view it as, three stages within this entrepreneurial life cycle. You've got the startup, the concept idea of just even formulating the business idea to begin with, then the formation and actually starting it, getting it off the ground. Then you get into the growth phase, which is all about growth mode and actually growing this business, growing this asset over time. Then the third and final stage being the mature stage, the exit stage. And, exits, of course, can, find its way in, numerous different avenues, right. Whether that be liquidation, whether that be transfer, whether that be, selling to employees, family succession, yeah. Exactly. So that can even have, a whole separate discussion in each one of those avenues. Right. So yes, and totally agree on everything kind of being kept at a very, very high level for this.
Yeah. And we'll work through this in those three phases. Some individuals think that they need to wait till the exit phase to get serious about how they think about this matter. And I think that's just, can things be done at that point? Absolutely, work can be done at that point. However, our advocacy is that it takes place in the thought process, starts much sooner in the process. Now, a lot of individuals that roll up their sleeves in that early stage, that concept stage, that begin, especially if it's their first enterprise. It's a different thing for a serial entrepreneur to have subsequent creation of entities. We're really talking about almost a first generation, first enterprise, first launch endeavor that someone's getting into. as that phase one, if you want to call it that, or that step one, or whatever. So let's spend a few minutes just talking about that. How does somebody even think about their balance sheet and this concept of investment management in those early days?
Yeah, and I think when you're in that phase and just trying to launch this business, keeping with any sort of investment that you're making, this business and the decision to launch this venture is really at its core no different from any other investment that you would make, right? Oftentimes you're saving up money to invest into this company just to get it off the ground. You may have friends and family willing to chip in and help with the business and getting it started. So it's no different from that initial investment that you would make in any other asset class. So really from that lens, an investment is really just, an investment day one, and then this promise or this hope, expectation of future cash flows and those being discounted back to today. And so really when you think of it from that lens, the decision, the market research to decide to launch this, business is really no different than any single asset that you would decide to invest in.
Yeah, except, well, and I guess when there's nothing to lose, there's nothing to lose at that point in time. And when people go all in, because you see a lot of people, they push in all their chips. And frankly, they push probably in chips more than they even have themselves, whether it be small business loans, whether it be friends and family capital raises that they bring into it. And that just runs a lot of risk. As John Chapman and I spoke about in a prior episode, more businesses fail than succeed, right? And so when you're taking in capital from friends and family, let alone your own capital you're putting into it, and the sweat equity that builds on top of that to make it a reality, it does need to be thought of well, what is that future investment? What is the future payoff in the cash flow stream when this becomes a real business? Because if you don't even have that future in mind, then how do you launch that idea? It's just an idea, and you're not going to have a return on that investment in those early years. And so there's not much of an asset allocation at that point in time, right? There is all the chips are in, people are starting out, and they're moving that along. Not a lot of our clients, none of our clients, I would say, really probably fall in that category as somebody's in those really early days, because they have an all-in mentality. However, when they progress from that stage into more of a growth phase, you talk about an evolution that's in there. What does that mean then in terms of how an individual would start be thinking about investment in a growth stage of their journey?
Yeah. And you brought up a really good point talking about risk, because no investment, yes, you want to consider the returns and the potential cash flows generating, but any discussion about return without talking about risk that's there, needs to be discussed and addressed. And obviously in that, phase one, stage one, launching the business, obviously with the odds being, 90% of the time startups fail, risk is pretty elevated at those early phases. So then as you're transitioning then into that growth phase, okay, you've got a business, you've got customers, you've got some revenues coming in the door, you actually have something here with your business. So then that growth phase then is all about, okay, how do I scale this thing? Again, each time you're attempting to pour more investment into this business, it's still being looked at as an investment. So whether that's from, savings that you've saved up along the way, whether that be from, investors outside of the business coming in, it still needs to be taken within that same context. Yeah. The risk is a little bit minimized because the business has actually proven itself to be, somewhat stable. Yet the next key challenge then is execution and how do we actually scale this thing? So there's lots of considerations into, is putting money into the business the right decision? Does diversifying away in smaller areas start making sense? I mean, a lot of opportunities start opening itself up in that phase.
And so in that growth phase, right, I want to spend quite a bit of time talking through this growth phase, because that is the time for individuals to be thinking about how this all works, how their estate structure, their tax structure, the ownership, what the future exit might be. Because if you do that earlier on, you can grow into the structure that you're putting in place. If you wait until after the fact, for example, I was having a conversation with one couple. Back of the envelope, let's call it $100 million balance sheet in the businesses that they have. And they had never done what their estate tax estimate would be. And all of it's illiquid. Now, they're not clients, right? We were just kind of talking casually. But they had never done even their estate tax estimate if the proverbial bus came along, and working through that and understanding it. And yet they wanted subsequent family members to be part of their succession plan. And yet, how are you going to pay the estate taxes at that point in time? And you'd want all that growth taking place outside of your taxable estate as you step through this. So let's spend some time on this growth phase, because you talked about, do I keep the retained earnings in the business to reinvest in the business versus diversifying away? How would you think about that? How would you look at the business and its value and its investment and its future growth to make additional investments in it versus taking some cash out and investing in some of these, other asset classes?
Yeah. And I would say in terms of the business, this is where, maybe an internal CFO could really be helpful in making some of those decisions as well. Because if you're looking to scale, whether that be productivity, whether that be geographical locations for the business, whether it be hiring the team, looking at each one of those decision points of what's the ROI on this? How much will this really impact the financials of the business? And what are the return expectations from that? Right. And then how does that then compare to assets that are available, whether it be in public markets, other private markets as well? And then just simply diversifying some of the risk, because at this point, maybe 95%, 100% of the net worth then is still tied to this single asset. Right. Does it make sense to start diversifying? How do you start doing that? Does it make sense to set up a 401k if the business hasn't already to begin diversifying into some of these other asset classes?
Well, it's because I just had a flashback to when I was speaking with Joe Pringle on a prior episode. And, Joe, we kind of joked that great wealth is created through concentration and great wealth is lost through concentration. Yep. And how you approach that. And back to stage one, people are all in, all the chips are in, they're growing this business, they're plowing earnings back into it to continue to grow what is it they're doing, but they're maintaining a level of concentration into that business. And you had mentioned something, the separation or the difference between the CFO inside the business versus what we strive to be, which is the CFO back with the family, right? The chief financial officer working with the family regarding how this business asset fits into the family's overall balance sheet as the business CFO, or some businesses with controllers, right? Maybe not full-fledged CFOs, are really working through how do they think about the financials inside of that business. So let's stay inside of the business for a moment, because you just hit on qualified plans, right? Non-qualified plans. Something Kevin Karani on our team, that's his complete focus with his area of the business, which is how do we work with our business owners in doing that work. Is that the first step, though, of diversification, of making sure you've got the right qualified and non-qualified plans within the business, would you say?
Yeah, I would say that's certainly one of them. In terms of, and this is different for every single business, but at what point do you actually start paying yourself a salary? We know in those early years, paying yourself a salary, isn't something that's certainly not guaranteed and not likely to happen for some time as you're building it. Once you start paying, yourself, okay, well then how do I take some of those earnings and then start diversifying away from just personal savings aside from retained earnings from the business? So that's one thing. Yeah. And then you get into, okay, from a business perspective, setting up not just for yourself, but for your employees as well at that stage, the benefits that come alongside with qualified plans, non-qualified plans, a great option then, especially if the business is matching some of those contributions into those plans, to really start diversifying. And you know what? If you're a really successful business, the business is really growing, you still might be extremely concentrated in that asset, but some of those smaller things that make sense from a, tax perspective, from an investment perspective, to start diversifying, reducing the risk a little bit, are just some great options for you.
Yeah, there's a conversation I had with a client recently, and even within the businesses that they have, multiple, in looking at it, the 401k, the profit sharing plan, how they looked at that was an ancillary type item for the employees, which is true, right? Yeah. It's a benefit, and they've got to approach it from that fiduciary responsibility that they have as the plan sponsor to the employees. But then there's also allowances, safe harbor allowances that come back for ownership to maximize benefits for themselves in a proper and healthy way. And that could even result in an ESOP exit or otherwise, which is a qualified plan structure. So we'll leave the qualified, non-qualified planning inside of the business as a separate topic. I keep making up new episodes as I go with this, but that's probably a separate topic. Let's go back to now this asset is on the balance sheet of the family. It's value that's there. You mentioned taking some distributions, maybe not reinvesting all of it, but taking some distributions and diversifying away from it. So you have a large concentrated position that's in that company, and now you want to start diversifying away from it. How do you think about that diversification away? Because if I understand you right, when you referenced that family office report earlier, you said 55% was traditional stocks, bonds, and cash. That other 45% then for the ultra wealthy is direct investing. It is their own businesses. I mean, those are the sort of things that fall into that other 45, and we'll expand on that a little bit later. You're talking about how to then tap into the 55% that's traditional stocks, bonds, cash, because that's how ultra wealthy do it. How they maintain the risks in their direct investing because they're balanced and they have reserves and they have cash on hand to do that. So how do you approach the investing in that traditional public market view?
Yeah, so if you take that business owner, entrepreneur's balance sheet and what that looks like at that stage, you may start diversifying, but that asset is really one part of that alternative asset class mix of that 45%, as you mentioned. Roughly, you look at the total allocation there, maybe 15 to 20% of those $2 billion single family offices. 15 to 20% maybe at the most is private equity, and then a subset is direct investment. So really, when you look at it through that lens, let's say the business at that point is 90% of the business owner's net worth. Well, by that logic, you're maybe 80% over allocated to illiquid, unique concentration in business risk. External variables. We just went through COVID and a lot of businesses suffered things that you're not sure could happen that may end up. So it's just opening yourself up to that risk. Not that it's a bad thing, not that we shouldn't be, risk taking in some of those ventures, because the, opportunities there are, extremely positive and for those few that are successful. Yet at the same time, how do you start diversifying away from that? Yeah. And so then you get into, okay, well, liquidity tends to be important in terms of preservation, which is then what shifts you to some of the public markets, whether it be public equities, public fixed income, to shift away some of that very concentrated illiquid risk that's kind of common with alternative investments.
And if it's somewhat terribly wrong within the business, that there's assets that are being set aside that are giving a bit of a cushion, right? They're giving a bit of a cushion to the world because you're trying to develop and grow this wealth within a concentrated. I laugh sometimes when individuals look, well, if somebody sold their business and we took all that cash and we invested in any one company, pick the greatest company you think in the world and you invest, people look at us like, well, that's crazy. Why would you ever do that? Yet that's exactly what they do in their business and in their private direct investing and how they're approaching it. And yet they would never do that from a public market view. I could probably get off on a tangent regarding the volatility, right? People look at the volatility of the public markets because they can see it every day. And sometimes I wish there was a ticker symbol for the private companies on the wall that's going up and down based on how the day is going, or for no reason at all that it drops. So when people think about that public market view, and they are diversifying away from where they're trying to hit the grand slam through their existing company, we're looking to say you got to balance out that risk profile. You got to start, leaning into some other structures that are going to be assets that are going to be there for the long haul. For individuals. So take a little bit through kind of the fixed income world, public stocks. I mean, how do you even think about the public market investing? Yeah,
so regards to public markets, but first, one thing that you brought up, volatility versus risk. I find it very interesting when, you might hear, oh, well, private equity doesn't have a lot of risk, it just doesn't have a whole lot of volatility. Those type of assets don't have daily pricing, as you mentioned. You can't look up a private equity index to see what it's doing on the day.
What standard deviation is.
Exactly. So just because, last year those type of assets don't get priced, and maybe they do quarterly valuation. So there's a key difference. That doesn't mean there's not risk there.
Right. The dispersion of returns is actually greater in the private markets than public.
Exactly. So one want to make sure we're making that clear distinction between the two. But then as you're evaluating, then it's kind of no different from how you're operating your business, whether it be yourself owning the business outright, you're an equity holder in that business. When you go into the public markets, it's no different. These are just much more mature companies. And then you can get into geographics. How much exposure do you want to have to U.S. markets versus international markets? And then you get into the fixed income world where, much more liquid, tradable securities that are out there, certain level of interest rates that you're attaining from that. Again, all of those different, asset classes, but also, areas within the capital stack of just much larger, mature companies, being able to diversify that risk. And because of the tradability, a lot of those assets being priced daily, especially equities, public equities, there's liquidity there. If something ever happened and you need to sell that, at least the price versus in the, business, you may not know what price you're getting if you were ever to having to, do a for sale or something like that.
Right. And over time, as business grows, it realizes success financially, the value's going up. This is where, from an estate planning strategy approach, the complexity is going to continue to grow based on the family's desires and their objectives, and how they think about inheritance and charitable giving and different structures that would be there. Still haven't met anybody that says that they want to maximize their tax that they're paying. Everybody wants to minimize it.
Yep.
So how do we think through even legal tax structures and the planning strategy side of it, back for the attorneys and the accountants to come alongside the family in terms of how we finalize what a recommendation or proposal would be and how that's put in place. But doing that on the front end and saying we're going to create some irrevocable structures, we're going to move some assets outside of the taxable estate, so that all the future growth now is estate tax-free back to the subsequent generations. And getting that up, it begs the question of placement.
Yeah.
So I'm going to take a simplistic shot at defining what placement is, but then we can expand on that further. And placement being the concept regarding the level of investment risk that you're taking inside of a specific account which is titled to a legal structure, whether it be a revocable trust, an irrevocable trust, a retirement account, et cetera, et cetera. I think of it like a football team, right? I mean, you have offense and defense first, but even on offense, not all the players look alike, right? Your wide receiver looks different than your offensive tackle, right? And the offensive tackle that's protecting your blind side has a different diet, a different risk mix within the investment world than your tailback or your slot receiver or anybody else. So when we think about that investment mix and we think about placement, how do you think about it from that technical CFA viewpoint and how we approach the challenge?
Yeah, so there's the very detailed tax-efficient asset placement, but before we even get into that, because there's a whole lot we could talk about there, I think in terms of the investment strategy, and you made a really good point of, doing this estate strategy during that growth phase as the business, oftentimes that business ends up being, the highest growing, asset that you might have. So being able to do estate strategy planning with that asset before it's reached its full mature phase opens up then the opportunities then down the road once you're in that mature looking to exit for what the investment strategy is going to be. And ultimately, a lot of it does depend on what's the legacy that these entrepreneurs are wanting to leave behind and what role financial capital plays in that. Because like you said...
Well, then we're in a great place for that conversation, right?
Yeah, we are. Because then you get into, okay, well, what parts of the estate then and what assets then are able to be grown, for the future, for generations down the road. Okay, well, it makes a lot of sense then from a placement perspective to have some of your, yes, riskier, but higher potential earning type assets in those structures that are outside the estate. Why? Because at that point, you're using your taxable estate assets to be living off of. So that's where liquidity income starts becoming more and more important as you're, maybe you're doing new ventures, or maybe you're, ready to be, retired at that point, or off doing, philanthropic activities, whatever that looks like. Well, okay, you use your in-estate assets then to be leveraging some of that, taking much less risk there versus assets that are designed to be given, years, decades down the road to future generations will have very different investment strategies. And so that's why the placement, working with the strategy, the work that I've seen you do, with clients, preparing them for this exact point to be having these conversations with clients, becomes all that more powerful if done sooner rather than at exit time. Because at exit time, there's only so much you can do at that point in time. It's not that you can't do anything, but it's just a little bit more limited in terms of the power of that planning.
It's almost the simplistic logic of keep assets more conservative inside your taxable estate that you're living off of and consuming, and still growing, right?
Yep.
And what happens upon your passing is a question from an estate planning strategy. Yep. But being more conservative, that you're not worried about your day-to-day and the noise within the system. It doesn't have to be only public. It could be private assets, but maybe slow growth private assets that you'd keep there. As by definition, you'd move those high growth assets outside. Why? Well, because you want the greatest growth on an estate tax-free basis built into the system. So placement in terms of just looking at the totality of a balance sheet, the totality of one's risk, and then where you're taking risk and where you're not taking risk to still meet the objectives, both in the day-to-day living as well as on that legacy basis for the future generations.
Right. And each of those assets aren't painted with a broad brush, too. It doesn't mean that all private assets are, super high risk, long-term type investments. You can get into some things like private debt. It's fixed income just within private companies.
So let's talk about that. So if I understand what you're saying, just to clarify for the listeners too, 55% ultra high net worth, based on the family office report that you mentioned, is traditional public stocks, bonds, cash, those sort of things. On the private side, then, that's 45%. So that leaves a lot.
Yep.
What are those? Just remind everybody, what are those type of assets that fall into that 45%?
Yeah, so the main type of assets, you get into private equity, two ways of it doing private equity, really through funds or direct. So what we've been talking about, individual asset, individual business, that's kind of thought of as a direct investment. You get into private debt, which, as I mentioned, is really the same thing as public. It's just private companies versus publicly traded companies. Again, just given the size of those types of companies, it has its own risk, a little bit more risky than public for sure. But it is a fixed income instrument. You can get into real estate then, whether same thing on the equity side or on the debt side of privately held, whether it be REITs or individual real estate projects themselves. Things like commodities, things like passion assets and collectibles. So really, it is a wide landscape, even when you look at private assets or alternative investments.
So let's talk about a little bit about collectibles, right? 'Cause that's a fun thing to talk about, right? And we hit on it at different times, and then we'll back into some of those areas. So we'll take a little bit of a detour here for a second. When you say passion assets or collectibles, what does that encapsulate?
Assets that families may be passionate about, and examples of that could be, if someone's a wine connoisseur, having a wine portfolio of rare wines that they can either store, use, hold for years down the road. You could get into exotic cars. You could get into sports memorabilia. I mean, there's a lot of different avenues.
Watches,
for that.
cameras, bourbons. I mean, you kind of go down the list. There's anything somebody thinks that they're passionate about or is a hobby that they could turn into. There always is a potential investing consideration that could come into play if you really know what you're talking about and the quality that you're looking at. You mentioned wine. Yes, I like a glass of wine every once in a while. So when you talk about wine, there's a lot of fraud that's out there.
Yep.
So when you think about, which brings up the question, manager select, if you're not doing it yourself, right, how do you even tap into somebody? Because there's labeling fraud, right? There's spoilage that takes place. If you're not keeping it refrigerated, if you're not keeping it, if you're transporting it too far, you could actually waste a bottle by just bringing it across the Atlantic from France. So as you think about those subjects, it brings in this question of manager selection. Yep. So how do you think about manager selection? Very broadly.
Yeah, so manager selection extremely important when you get into the private asset, private market world. You mentioned this a little bit, the dispersion that's there. The difference between, for example, one U.S. equity large cap manager and another one, it's maybe 1%, 1.5%, 2%, maybe at the most. You start getting into, private equity, private real estate, private credit, those dispersions in returns, same asset class, but based on the manager, you might have a 10% difference in return from a top quartile manager to bottom. Private equity, I think it's close to a 20% type dispersion, which can have a huge ramification of, obviously the performance and your experience in that asset with that manager. So due diligence becomes, arguably the most important thing when you get into this private asset world. And so when you look at, a collectible, if you're not doing it yourself, in terms of all of those things that you mentioned, even throwing in things like security, being able to visit the locations, doing things that you wouldn't normally think you would have to do, you have to be all that more cautious when you start getting into that world.
And does that matter on the public side of the markets? And then we'll come back to private, but does manager selection in the public markets, does that matter as much these days?
It does. The reason why I say it does is because that's my job really, right? In terms of finding those managers, finding those strategies, in terms of, 1% to 2% may not, sound like a whole lot, but over the course of 10, 20 years or so, for as long as we'll be investing these assets, that does start to add up. And so, there's a lot of reports out there in terms of, active strategies, whether you look at, SPIVA report and, most managers not being able to, outperform. Don't want to get too far down that road, but it does matter. It's just you're not going to see the dispersion of returns in that world versus what you will in this private world.
And we're not suggesting go buy the S&P 500, right, or go buy the aggregate bond market. There are methodologies that come into play to say the efficiency of the capital markets tend to work against managers. You brought up SPIVA, which is the S&P index versus active managers, which just demonstrates over time that active management is got a tough hill climb and tends to underperform the benchmark that they're trying to beat. When you can get lower cost, more tax efficient access on a rules-based methodology. It's why we like the factor approach that we take to both the equity and the fixed income side of the world. So managers still matter, but it's managers from a rules-based methodology within the really efficient markets. But now back to the private markets and the inefficiency that's there, then the manager does matter a lot more. So how do you go about due diligence and the thought process regarding who we work with, at Clearwater, in terms of managing clients' assets, the fiduciary responsibility we have back to them, and rolling up our sleeves and really digging into who we would look at as a manager we'd potentially work with?
Yeah, so in terms of due diligence, one of the things first is kind of the top-down approach. Does this asset class make sense? What's the world that we're in right now? What's the environment look like? Does this even make sense from an investment perspective? If you answer all those things, it's like, okay, let's start looking at managers, and there's a lot of managers that are out there. In terms of that, it's, okay, what's their investment strategy? What are the people that are there? What is their, operational due diligence that they're doing on the private companies that they're considering for investment? Visiting with the team, visiting with the due diligence team that's there, going to their on-site and doing on-site visits with them. The due diligence process probably takes, 6, 12 months, even more than that, before really getting comfortable with a manager, just because there is so much you need to start looking into. And you mentioned something with factor investing. These publicly traded companies have these, financials readily available. There's no secret to it. Private companies, though, it's tough getting your hands on, financials. It's not like they're necessarily, available to the public at all times, right? So the need for that due diligence and understanding, if you're, using that manager then to make those decisions for you, well, then you need to know everything there is about that particular manager to get comfortable with him and his responsibility to be finding the right investments for you.
Him or her, right?
Him
in
or
terms
her,
of
yes.
The ability and the capabilities of individuals that are out there and frankly on a global basis as well. I've been thrilled with Kevin Nolte's addition to our team, given his prior auditing experience at EY regarding how you approach these and putting out that CPA lens and digging into what the data is really telling us, right? And what those returns are really telling us, what the vintage analysis and where you need to poke and prod further to go into understanding, and then your thesis about the future. So it really does take a team effort to go about that. And this is where I step back with a lot of individuals, clients, families that have their business. They are their own manager, right? There's no one that they trust more than themselves. It's why they go into the office every day to sit on the highest value, asset that they have in their balance sheet, because they're the one managing it, right? And they may not be right every time, but they trust themselves more than they do anybody else in terms of making decisions. And if they don't trust themselves, it's frankly where they assemble boards and get involved with boards in order to provide different perspectives. And that actually demonstrates a great level of humility when somebody can open themselves up, have a board, have governance structure, and actually lends itself to a legacy play, especially when it comes into family succession within a business, so that there's accountability and different perspectives that are still being brought to bear in that mix. So an individual that's got that, and they've got that business, they're diversifying away during this growth stage, they're getting their estate structure set up, they're thinking through placement of where do I gift assets out of my taxable estate to have that growth be tax-free, and yet generate the cash flow for themselves to live off of into the future. A lot of times individuals don't have need for additional private market exposure. They're already concentrated, they already have that. But then if we get to a point and going into that third phase, somebody's grown it, and let's leave all the different potential exits out. We talked about ESOPs, right? If employees want to be transitioned through a qualified plan, family succession, right? There's multiple different ways. But let's say that somebody has a business that they are going to go through a monetization event, a sale. Whether they they roll in some equity or not, let's leave that out. They have a significant amount of liquidity now that is made available to them. How should they be thinking about their balance sheet and the allocations at that point in time? This is when they start introducing potentially some of the private market investments?
Yeah, potentially. And assuming that kind of full liquidation, okay, you've had this concentration, and concentration can create wealth, right? And so they've done that at this stage. So now that that's there, it's all about preserving, still wanting to grow it, but grow it in the right places. And so one way to preserve that wealth then is diversifying, which then you get into that mix of, I still surprises me that these single family offices still have 55% of their net worth tied up in liquid, publicly traded asset classes, versus what you may hear on TV or the headlines about how much these families may or may not have in hedge funds and everything that's out there. To still have such a large portion in these liquid asset classes really speaks to the importance of diversifying in order to preserve wealth. So then, when you get into that event, you've had that event, one of the first things is paying taxes, and hopefully that's minimized with some of the planning that's been done ahead of time, and making sure now is a great time because you've got 5% interest rates on cash. So while waiting to pay that tax bill, at least being able to earn some return on the cash set aside for that.
Yeah.
But after taxes are set aside, any charitable giving that's still left to be done at that stage, then you really start looking out to say, okay, what does this look like? And again, 55, 45, again, no hard and fast rule. You're going to have families with, allocations that look different for each one. But then that's where, okay, what does that legacy look like? What does the placement of assets look like?
Right.
And then start investing. And this is where, okay, let's say it's a $100 million type liquidation. You probably don't want to be investing that in that allocation on day one. You probably want to be feathering that into various asset classes over time versus just taking all that and plowing it into one set allocation.
Yeah. So the saying, right, that our job isn't to make you rich, it's to keep you rich. In terms of you've hit the home run, right? Your business was successful, it's grown. You have now this high-class challenge of how you manage that wealth, and also not looking at taking the same risk. right? There's a lot of individuals, some of them would go back and say those were the fun days, the good old days, right, of eating frozen pizzas and getting the startup going and achieving that, but I never want to do that again, right?
Right.
And so they want to move forward and make sure that they've got the capital to do those things that they want to do. But they also know that if anything else goes wrong on them, they still have the assets protected, with whether it be the trust structures again or even the underlying investments that people are holding. You mentioned on the exit or the charitable pieces, this is part back into that growth phase of thinking through what this means on the personal balance sheet and what this asset looks like. And no matter how early you can gift that out of your taxable estate to allow that estate tax growth to happen, the same comes into play when people are thinking about charitable giving. I was having a conversation recently, and I'm actually speaking to the Western Suburb DuPage County Bar Association tomorrow evening. So it's a county on the west side of Chicago here, a lot of wealthy Western suburbs and estate planning attorneys, and we're talking about philanthropic strategies. And a lot of people have missed. Now, interest rates historically are not like all of a sudden through the roof, but recent history. I mean, interest rates and what the Fed has done to fight inflation has moved rates up, where, for example, charitable remainder trusts now are the most attractive that they've been in over 15 years, given where the rates are at and the ability to discount income streams back to an individual. But those sort of items have to be put in place. And that structure can avoid capital gains on the sale of a business, can get a tax deduction, can create a cash flow stream back to the individual. Do you want to tie everything up into that? Well, no, but a portion of what that strategy could look like. And that's the discussion tomorrow with the Bar Association that a lot of people miss. But you can't wait until your event. You can't wait until you have an LOI in place and you're ready to move forward. You have to integrate this into your overall estate strategy, and that doesn't happen overnight. And it probably doesn't even happen within a year. And if you wait to the last minute, it's one of those items that get the attorneys on the phone, right? Get the accountants. It can be rushed, but that's not good planning if something is rushed. It has to be really thought through, because then you're back to, well, what are the placement? What is the investment mix that would actually be into that entity, which is different than every other entity that's out there for people. So when you've done research, as you've developed, I mean, you're a chartered financial analyst, right? The CFA designation, very high on the technical order. You're working with managers, both public and private, across the country in terms of how we think about the investment mix. What other resources do you tap into? What other reference, we talked about, like, what's a favorite book reference that you go into on this subject as you're keeping your knife sharp in terms of delivering service back for the families that we serve?
Yeah, I would say the beauty of our independence is there is no shortage of resources that we can tap into across all asset classes, across thought leaders in the industry. One of the books recently on this matter of direct investing and looking at business as an asset and what that actually looks like. It's a book called The Complete Direct Investing Playbook by Kirby Rossblock. And I just found that really interesting. It is pretty technical in terms of, assets, and you'll get into, financial statements and understanding and returns and risk. And, you'll get into, a wide range of topics. But if you're someone who's really wanting to understand the technical components of what direct investing looks like, it's just been a great read that I've found.
So for our listeners, I've got a big smile on my face right now, as you know, because when you shared that actually previously, and unbeknownst to me, I was just with Kirby last week as she was facilitating an ultra wealthy families family meeting. And so the preparation with her, the work going into it, how she ran that meeting. I've been referencing her material from when she published the Complete Family Office Handbook as well, and the technicalities that Dr. Rossbach brings to her work and the value that is to us in the broadest sense of how we're approaching this challenge and asking these questions on behalf of the families that we're serving. How do you see the future of what let's call the 45% world, right? Alternative investments versus traditional 55%, the public markets and cash and et cetera. The 45%, I'll wipe with a broad brush, call that alternative investments. How do you see alternative investments evolving for the next decade, next 15, 20 years even?
Yeah, I would say I think it's going to get more pronounced. We talk about the public side of things, the impact of artificial intelligence that it's having now and will continue to have in the future. One is very exciting for me to be able to, leverage that and use that into the future, but very tough to leverage artificial intelligence on the private side. We'll see what those next 10 to 15 years as it relates to artificial intelligence looks like. But then as you're thinking about, private markets, I think there's a couple of really interesting things going on. One, there's been a whole lot of, flows going into the 45%. Private debt is one of them. The amount of private debt in that space is really, really growing. One, because you're seeing banks having issues with some of the, loans that they've made, talk about commercial real estate. And as banks start pulling away from some of the investments that they're making, well, private debt has actually started stepping into some of those areas. So I actually think you'll continue to see an explosion.
You're talking, and right now on that specific topic, you're talking about the challenges within commercial office space, given this post-pandemic hybrid work world of vacancies that are out there, and then the debt that has to be refinanced, right? So I just wanted to have a little bit more context around that, is that, there's some challenges out there that we believe that approach our investment policy committee that you lead with John Chapman as our Chief Investment Officer, and how we're even thinking about these things from both the public, but it's also the world we live in, and it affects the private markets as well.
And I think one of the other interesting things in private equity that we're starting to see is these private equity funds that are making these investments in private companies. Most of those transactions then are actually sold to other private equity funds and firms. So as this space continues to evolve, okay, who's buying what and who are you selling it to?
Right.
I think that actually makes the returns a bit more challenging if all of a sudden you've got so much asset flow into this space and it's private equity funds buying, assets from other private equity funds. What are the multiples that they're then paying for? So then I think that actually gets back to the importance of due diligence and what those private equity managers' strategy is, what's their exit plan, knowing all of that ahead of time. So I think there's a lot of exciting things in the space, yet there's also a few things that pose questions of what this will actually look like over the next 5-10 years or so.
Yeah, and it is fascinating because there's a bit of a quote unquote democratization of alternative investing. There's various platforms you brought up, whether it be collectible wines, whether it be artwork, right? Whether it be autos, like you said, and collectible
farmland,
cars.
And
farmland, right? Farmland
farmland
aggregation. And talking to some investment bankers, even in some dialogue last week, right now, because of the dramatic change within the interest rate world, and everybody knows discounted cash flows, and how do you think about this, and where rates have moved, and yet there's a hesitancy. It's kind of like right now with residential real estate, there's a lack of supply in the market. At the same time, you always look at real estate's, local, or location in terms of it. But broadly, there's a lack of supply coming into the market. And there's also a lack of supply in transactions right now. So although individuals were concerned about multiple contraction in the private market to follow what the public markets did in 2022, that there's pressure there, right? Everybody's sharpening their pencils a bit more. However, the lack of supply of transactions and the amount of capital that has to get deployed, because a lot of people have seen the flows flow into these private funds, that has to get deployed. And if there's lack of supply, that's bidding it up. I'm not suggesting it's like residential real estate was, not that long ago when people were walking in and getting X amount over asking, and there was 20 bidders on it, and you had to have an all-cash buy. But there's still transactions getting done within the private markets. And like we always have clients that are passing away, it's the nature of the business. We always have clients that are also working through transactions, and deals are still getting done today, and yet into the future, if what you're saying comes to pass, that there's going to be more attraction of capital into the private markets, given some of the challenges in the public markets and in growth and what that means for certain companies too. If somebody's thinking about taking a private company public, right, what does that usually indicate? Because in the public side of it, a lot of people want to come in and be like, IPO, you got to be in an IPO. And yet if a banker's doing their job well, they're maximizing the value to the private holders by selling at a point when they think that maybe that growth is exhausted. How do you view public market, private market to public, and IPO as an exit and the thought process around that? Because we get a lot of questions on that from people who are going, I got to be in the next IPO, I got to be in the next thing. What's your view on it?
Yeah, I talk about IPOs and all of a sudden they become public and it starts getting the headline. You'll see it on, all of the news networks about this new stock becoming public, and it may, shoot up, it may shoot down. But obviously for those private holders, it really is just an avenue in terms of what that exit actually looks like. And you mentioned it and hit it right on the head. The importance is really trying to get the right value for that company. Once you've made the determination to exit, whether that is, in some cases, it may be an IPO. Not going to talk about SPACs, but SPACs are a new way of, exiting and finding a different way into the marketplace. Whether it be a liquidation to a private equity firm or a strategic buyer, whatever it looks like, it's in those relationships and that team that you're putting around yourself as the business owner to find what that best, avenue is and what's likely to attract maybe not necessarily the most value. That's probably the most important consideration in it, but not necessarily as you think about the employee base and what that next buyer is going to, So there's a lot of other considerations that come into play when choosing what that right avenue is. But I think having the team around you, the investment bankers, the attorneys, the accountants, the financial advisors, those external CFOs, to really say, okay, here's all of your strategic options. IPO is just one of them. Doesn't necessarily mean it's the right one.
And for listeners to get a little bit more of a feel, we don't get compensated by anybody but our clients, right? So no manager, no fund company, no anybody is paying us to say anything about them. Our clients are basically compensating us to go figure this out. And if they knew what we knew, well, those are the decisions that we're making on their behalf in terms of how we allocate capital. And this is another shift, I think, that's taking place within the wealth management space. You talk about a little bit that democratization, right? The access, the flows that are going there, how that fits into a healthy portfolio. It's not just public or private, right? It's not that binary. And when individuals are looking at that, it's one of the shifts we've even done. Historically, industry has been being paid on assets under management, right? A percent of that assets under management and how we view that. However, I don't want clients or prospective clients thinking that the only way we get paid is if they sell their company and they have a bunch of cash that drops in and we're deploying that. And I also don't want to be hindered from deploying that in terms of a good private market investment that would be there. And the client wondering, are they just convincing me to sell my company and are they not going to have me investing in other areas that make sense in the total portfolio? And it's another one of those shifts that's taking place that we are leading with, which is having an assets under management plus retainer approach, because we're working on both the assets and the liabilities of a balance sheet, the totality of managing that mix, that placement, the estate structure and where assets are at, and making sure it's the right mix and the healthy mix. But that also has to continue to remove the conflicts of interest that we were based on, and the independence and that transparency and that view, and that we're sitting on the same side of the table of the families that we're serving. And that absolutely comes into the investment management component of what wealth management is more broadly and how we approach this.
Right.
What was your favorite movie on this subject?
Oh, gosh. Favorite movie, we talk about the financial industry from an entertaining, but there's also some serious and real consequences. The Big Short was one that I, enjoyed. It also highlights, though, the importance of risk, the importance of, things getting stretched and managing that. So while, the movie may make light in some areas of what obviously transpired at that time, there's also some real things and some real learnings from that event. And I feel like if we don't take the time to really understand, and go through events and take that into the future with us, the ramifications, then, we're just doomed to repeat it, I think. I think that just puts into whole perspective the importance of risk. And, for these business owners that have, had success, they've gone through the exit. the whole point at that time is preserving the wealth that's already been won and achieved that they've done.
Yeah, it does. It takes a very hard and sad because people were, badly affected by it. Other people then took advantage of that opportunity, right, where they did have the dry powder and the capital and had capitalized on what had transpired. And you hate to see somebody in a predatory way taking advantage of that. Yeah. And yet when things and assets get mispriced, somebody's standing in the wings ready to jump into that. I think it's, so it's both entertaining, very sobering, right, in terms of what could happen if things go wrong, and also educational. And part of it is that education and going deep and, us sitting together with clients, walking through their understanding of how the estate is structured, where the liabilities, where's the cash flow coming from, where are they taking risk, and how that gets blended together. Because sometimes when it's all blended together, people can lose sight of what the specifics are. But when you think about all these different buckets and the different investment components that come into a well-structured investment strategy that follows the wealth management strategy, it's of huge benefit. So education is a big deal that we've got to continue on. Although I don't think either of us are going to be starring in a feature film someday.
No, I don't think so.
Think that's going to happen. So we'll keep the day jobs on that front.
100%.
Tyler, any closing thoughts for our listeners on this subject of investing across the entrepreneurial life cycle?
I guess I would just re-hit on some of the things we talked about in that the importance of, what's the legacy, that you're really wanting to leave behind, and what role do you want that financial capital to play in that? It's not all about the financial capital and how you're there's much more important things, but financial capital can play a huge role in that. So what role do you want it to play? Then getting around the table with that team, that external CFO, to really then architect what this strategy looks like so that when time comes for an exit, whatever that looks like, you're in a much better situation. And then from an investment perspective, everything is flowing through to what that chief legacy ultimately is, and you've done the planning to maximize the benefit ahead of time and just set yourself up for even more success post that exit.
Yeah, you reminded me, Eric Almquist of Bain Consulting did great work on the elements of value that you deliver back for individuals. It's documented in the Harvard Business Review article. I think it was 2016, but people could Google that and take a look at it. But those elements of value come back to societal impact, life-changing value. That's the highest order that we play in, right? In terms of how we want to come alongside families, because that's actually what they're seeking to achieve. In doing all of this with excellence, that has to be part of the way we think about it. But it's to that higher level of what the family's actually solving for, versus what the Fed may or may not do at this meeting or the last meeting or the next meeting, and how they're approaching it. So thank you on behalf of Clearwater Capital Partners and the work that you do for the families that we serve. It's outstanding. I can't believe we're a dozen years in together in working through these, with hopefully many decades yet to come together too, Tyler. So thank you so much for joining us today. And for our listeners, if you want to join the conversation and continue it, please email us at clearconversations@ccpwealth.com. Thank you and have a wonderful day.